Who's the kind of person or entity that would stand for deliver to the tune of $2 billion in silver?
Well, I mean, in China, it could be a speculator, I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and proper. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move it's rather like, when you get a dislocation in the market, the price just goes crazy. We saw this with nickel on the LME, was it 18 months ago? In that case, it wasn't a shortage of nickel. There was a shortage of deliverable nickel, because the nickel had to be delivered, if you like, in accordance with what was required under the LME contract. And it was a Chinese nickel business, which had loads of nickel, which it could have delivered, but not in that form. So it reneged on the contracts. And of course, the LME then had to sort of strike out any contracts that were taken out over that period. In the case of silver, it's different. It's not there. It is not there. It's gone. It's as simple as that. And of course, the other thing is that any industrial entity which has got a stockpile, is it going to let it go? In the past, it might have traded a bit, but under these circumstances, oh no, certainly not. We're going to hang on to our silver because we won't get it back if we put it into the market. So it's almost become, it's a Giffen good. I've written about this a few times. A Giffen good is one which sort of upends the normal supply and demand relationship being sorted out by price. Price rises and, supply increases as a result. No, what's happening is that as the price rises, the supply is diminishing, and that's having a catastrophic effect as far as industrial users are concerned. And of course, it's only just beginning to catch the attention of people in the markets who are sort of thinking, should we speculate by buying silver? Should we buy silver ETFs? Indian ETFs suspend operations back in the beginning of October because they couldn't get any metal. You could easily see the same sort of thing happening with ETFs in the West. SLV and so on and so forth. They may be forced to do that. I don't know. There's just no silver. I think that's the point, Dan. The spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot, and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it, and premiums and things. We can trade this. They're not doing it because there isn't the liquidity to do it. Because if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied directly to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock, not shorted, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on. Which is one reason why I'm not at all keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. If derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market. I think the answer to that, I've been watching, in London, we've got the largest silver mine in the world, actually, Fresnillo, is listed on the London Stock Exchange. And it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price. It's behind the silver price most of the time. And it maybe catches up a bit the next day. The idea that it correlates quite well with the silver price, the idea that investors looking to buy or sell Fresnillo, SLB or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying, silver's the game in town, we got to go for it, we're going to buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like.
So there's a lag involved when it comes to the mining
I
stocks.
think there's a bit of a lag. And I mean, basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver. And I've just explained why the market is short, et cetera, and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers.
If you've been watching the silver market over the last few months, you'll know that something extraordinary is unfolding, something that no analyst from Goldman to Zurich, nor any algorithm in the depths of Wall Street's machines has truly prepared for. And to the viewers who've been following my work, let me say this. I've been studying precious metals for decades, and even I have rarely seen a confluence of forces quite like this one. It's not merely a supply squeeze, it's a structural collapse of the Western silver market, and most participants don't even realize it yet. We start with the simple observation that the kind of entity that stands for delivery of $2 billion in silver is not your neighbor down the road, nor a YouTuber stacking maples. It's not the retail investor at all. These are industrial giants, sovereign-backed enterprises, refiners, state-owned manufacturers, energy grid developers, EV producers, entities that cannot survive without silver. Not prefer not to, cannot. And in today's world, the industrial system is learning perhaps a decade too late that silver simply isn't there in the quantities they were assured existed. Think back to the nickel fiasco on the London Metals Exchange, when a Chinese nickel producer was caught short on the wrong grade of nickel. It wasn't that nickel didn't exist. Plenty of it did. But it didn't exist in deliverable form according to the contract. The LME, in predictable fashion, tore up the book, canceled trades, and saved the institutional participants from ruin at the expense of market integrity. That episode should have been a wake-up call. Instead, it was quickly forgotten. But what we're facing today is far worse, because in silver's case, the issue is not a mismatch of contract grade. The issue is that the metal itself simply does not exist in the required quantities. People imagine vaults full of deep reserves. They picture the COMEX and LBMA as overflowing warehouses with vast industrial shelves of silver bars waiting patiently to be allocated. This is mythology at best, a fairy tale at worst. Industrial entities with strategic stockpiles, solar panel manufacturers, electronics producers, defense contractors, they are not releasing any of it back into the market. They are hoarding it. They know that once silver goes out the door, it won't come back. They know that prices rising will not conjure metal into existence. This is what economists call a Giffen good. The higher the price goes, the more people hoard and the less supply becomes available. It is the opposite of every textbook model taught in universities. But that's the problem. You cannot map a monetary metal like silver into a Keynesian supply-demand diagram and hope to understand anything. As prices rise, the supply vanishes. And as supply vanishes, prices explode. Industrial users panic, and sovereign entities, particularly in Asia, tighten their grip on inventories. Meanwhile, Western investors, they are asleep, utterly uninterested. The average portfolio manager can recite NVIDIA's PEG ratio, but couldn't tell you what a silver lease rate implies. They understand the options chain for Tesla, but can't differentiate between an allocated and an unallocated bar. And this is reflected in the miners. Fresnillo, for example, the world's largest primary silver miner listed in London, has moved behind the silver price, not ahead of it. In a normal metals bull market, miners lead. Today, miners lag because investors don't yet believe there is a bullion bull market. They don't understand why silver is rising. They think it's a temporary distortion, a quirk of speculative activity, not a symptom of an exhausted system. I've watched this behavior for years. Western investors do not buy silver miners until the move is almost over. They did it in 2011. They did it in 1980. They will do it again. They chase what is familiar. Technology, AI, the safe tickers recommended by CNBC. Meanwhile, the real story is unfolding quietly, and it is physical. Let me remind viewers that India, whose silver market dwarfs the US retail market several times over, had to suspend silver ETF operations earlier this year. Not because investors were panicking, but because there was no metal available to acquire. The trustee said, in effect, "We cannot source silver at any price," which is perhaps the most important sentence anyone interested in monetary history could ever hear. When essential metal cannot be sourced at any price, the monetary system built upon it begins to fracture.
Silver, there's no doubt about it. There is a liquidity squeeze. And in fact, in both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. It's obviously a little bit, but I mean, it's tiny. If anything, I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement, because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events. Silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought.
If it's not retail buyers taking this thing up higher, who is?
Well, this is the point, Danny. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets.
Oh, yeah.
And there was, actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So yeah, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver.
Silver's revaluation is not a theory. It is a consequence of arithmetic. And arithmetic, unlike politicians or central bankers, does not lie. We begin part 2 with the observation that silver mine supply has been in structural decline for years. Peak silver occurred in 2016. Since then, ore grades have fallen, capex has fallen, discoveries have fallen, and most new deposits are located in regions of rising geopolitical instability. Even Mexico, the world's largest producer, is seeing increased political scrutiny over mining concessions. Recycling cannot fill the gap. The global deficit is now measured in hundreds of millions of ounces annually. But deficits alone do not cause a supernova moment. What causes it is that the system built to mask the deficit has failed. When 42 million ounces stand for delivery in 2 days on COMEX, that is not normal. When 90 million ounces leave COMEX registered inventories in 2 months, that is not normal. When the LBMA tells members that settlement will require 8 weeks instead of 2 days, that is not normal. And when industrial buyers are willing to pay premiums 20% above spot to guarantee allocation, that is not normal. We are witnessing a collapse in confidence in the Western paper pricing system. And when trust collapses, markets fracture. Let us discuss why sovereign entities are accumulating so aggressively. Many viewers assume China and Russia accumulate metals simply to hedge geopolitical risk. That is partially true, but the deeper reason is far more profound. The West has built a monetary system on the premise that debt is money and that promises are equal to payment. This works only so long as the promises are believed. But after the 2008 crisis, after the 2020 monetary explosion, after the geopolitical fractures of 2022 to 2024, confidence in these promises is eroding. China understands that the future is not paper. They understand that gold and silver will play a central monetary role in the next system. And they understand that whoever controls the refining, not merely the mining, controls the market. This is why they built Belt and Road, why they purchased deepwater ports in Peru, why Chinese companies are buying ore from South America at double the global price, why they are expanding refining capacity that already dominates global throughput. It is not because China is bullish on silver as speculation. It is because China is preparing for a world in which the West no longer sets the price. And it is not only China. The Gulf states are accumulating, quietly, discreetly, and with long-term intent. India is massively increasing silver imports. Even Turkey, which has endured repeated currency crises, is buying silver and gold at record pace. Meanwhile, Western analysts continue to assure investors that the dollar is strong. They measure it against the euro and congratulate themselves. But measuring the dollar against another fiat currency is like declaring you are dry because you are less wet than the person standing next to you in the rain. Compare the dollar to silver instead, and you will learn the truth. The dollar has lost roughly 70% of its value in silver terms in the last several years. That is our real inflation. This is why silver's ascent is not a bubble. It is simply the market acknowledging the decline in fiat purchasing power. And yet, astonishingly, Western portfolio managers remain uninterested. They do not understand why silver stocks are not leading. They do not grasp that these equities are not rising because the investment community is not participating. The miners are being pulled up by spot, not pushed up by investor optimism. That is the most powerful signal of all. This is a physical-driven market, not a speculative-driven one. Meanwhile, a few institutional voices are beginning to wake up. A tweet circulated last week showing that industrial silver consumption has outpaced mine supply in 14 of the last 16 years. The caption read, "Silver isn't undervalued, fiat is overvalued." That sentiment captures the moment perfectly. And yet, the majority of asset managers still believe that silver is volatile, unpredictable, or difficult to model. Of course, it is difficult to model. There is no model for monetary crises. Let me now address the viewers directly. If you are waiting for confirmation from Wall Street before buying silver, you will be waiting until the price is 10 times higher. These institutions do not lead, they follow. They buy after the revaluation, not before. By the time silver ETFs halt creations, by the time miners surge 200% in a month, by the time CNBC hosts proclaim the silver supercycle, the real move will be over. People ask me, Alasdair, where do you think silver is heading? The truth is, its potential upside is unknowable because we have no historical precedent for a global monetary system built on sovereign insolvency and a simultaneously collapsing metals inventory. But we can say this: the price must rise to a level that destroys industrial demand, restores equilibrium, and reflects the monetary premium returning to silver. That number is not $50. It is not $75. It is not $100. These are stepping stones, not destinations. The shift will not be linear. It will be chaotic. Futures markets will seize up. ETFs will face redemption stress. Refiners will prioritize sovereign clients. Western vaults will bleed until the metal is gone. At some point, price discovery will migrate east. This is why I often tell viewers, do not buy silver because you think it will make you wealthy. Buy it because it will preserve the wealth you already have. We are entering a period in which wealth stored in fiat instruments may evaporate. Bonds, once considered safe, are now instruments of guaranteed loss. Stocks are priced for perfection in a world that is anything but perfect. Real estate markets are sustained by artificially suppressed credit spreads. None of these are safe harbors. Only gold and silver have survived every monetary transition since the dawn of civilization. And only silver faces a structural shortage so severe that it may redefine our understanding of scarcity. By the time the broader public awakens to this reality, silver will have moved beyond their reach, not because it is expensive, but because it is unavailable. This is how monetary history progresses, slowly, invisibly, and then suddenly, all at once. The Western pricing system is in its invisible stage now. Soon it will enter the suddenly stage. The question is whether viewers will recognize that moment before it arrives, because when the final break occurs, there will be no warning, no press release, no analyst note, no chart alert. You will simply wake up one morning and find that the silver market you thought you understood is gone. We are witnessing the end of a 50-year experiment in suppressing the monetary role of silver. And like all experiments built on distortion, it is ending abruptly. Prepare accordingly.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.